As you probably know, the stock markets are down significantly from their all-time high reached just last month. That is why in less than a month I am sending you another message. We've been saying for some time that we are due for a downturn. Typically every 5 to 7 years we have a drop of 20% or more in the markets. It's been over 10 years since we have had a significant down year. Last year, many individuals with a well-diversified portfolio gained 10 to 20% or more. After this year's pullback so far, we are officially in a bear market. History will remember that coronavirus was the black swan event that started it all. If you have followed our advice, then you have a well-built portfolio that blends stocks, bonds, and annuities to meet your retirement needs. Remember, your retirement will last 10, 20, 30, or more years. I've said many times that proper retirement planning is a marathon, certainly not a sprint. It is best at times like these to resist the temptation to overreact to a short-term event. No one knows what will happen for the rest of the year in the market. We can, however, predict that things will most likely get worse before they get better. It doesn't matter if it's a virus, a military conflict, an election, or some other event. The difference between successful investors and unsuccessful investors is that successful investors do not make panic decisions. To put things into perspective, even after this huge sell-off in the market, we are only down about 10% from the same date last year. It is normal to be nervous. The last 3 years, we have seen double-digit returns to the upside. Historically, markets have always gone up and down, and that is why we spread your retirement money over several different types of investments so that we have the smoothest ride possible through your retirement while attempting to capture as much return as possible. So what are we doing as Strategic Wealth Designers about the volatility? If you remember, we did profit taking in January of this year when we did a rebalance in anticipation of an event just like what we are seeing right now. Within the past week, we sold off all of our international positions as we continue to believe the United States economy is better suited than Asia and Europe to handle a crisis like this one. Those proceeds are sitting in cash as we consider what to do next with them. Today, we added to our cash positions by selling off some of our domestic stocks that do not pay dividends, and we were adding positions that will do well if the market continues to fall. Currently, we continue to hold gold, bonds, and dividend-paying stocks within our various portfolios, plus you may have guaranteed funds in one of the insurance companies that we work with. If you are not a client of Strategic Wealth Designers currently, take a look at the moves your advisor has made during the recent volatility. If they, for the most part, have done nothing, you should consider finding a new advisor. Now is a good time to ask yourself, what are you paying them for if they've done nothing? We haven't panicked, but we haven't buried our heads in the sand, hoping this will blow over either. If you have heard from your advisor and the only advice that they offered you is to ride it out, sit tight, you're in it for the long run, it's just a paper loss unless you sell, and you don't need this money right now anyway, then I think it's time for you to get a second opinion. If you have a large assortment of mutual funds and bond funds, then talk with one of our advisors about other investments that might be more appropriate for you right now. Recently, in some of our meetings in our offices, individuals have told us that they would like our help, but want to wait until they get their accounts back to even. We believe that is a mistake. A bear market is defined by a decline of at least 20%, but most people don't realize that the average bear market decline is actually 38%, with some indexes in the last bear market we experienced from 2007 to 2009 being down as much as 60% or more. So take advantage of the opportunity that you have right now to put a bit of a safety net underneath your accounts and kind of draw a line in the sand and say that's it. We're not going to allow the account to go down any further. There are options available to you where you can stop the loss potential but still have the opportunity to participate in the growth of the market when things recover. This is not a time to just hope this blows over, especially if you are close to or already in retirement. There's a story that I'm reminded of a gentleman that I met with in late 2007. He's a retired doctor in his early 70s. He had his money invested with a close friend of his who was a stockbroker. When he met with me, I told him that he really had too much risk in the portfolio, but the value had fallen recently from its all-time high, so he told me he really wanted to wait for it to get back to even, and that he really liked the guy that he was working with, so he was just going to stick with him. I warned that doing nothing would be a mistake, but he decided to stay the course anyway. I saw this gentleman again about 6 months later, and his portfolio had fallen about 20% as the financial crisis began. I told him again that I felt like he had too much risk, and he said that he really liked his advisor and he felt like things were going to get better soon, and he was just going to ride it out. About another 4 to 5 months later, I saw him again, and he was down about another 35% from the last time we had talked. Again, I told him that he had too much risk, but he told me that his advisor, who he really liked, had told him that he was the one that lost him the money, and he was going to care more than anybody else about trying to make that money back for him. So he was going to give him that chance. Well, I never really talked to this gentleman again. However, I did see him about 3 or 4 months later. My wife wasn't feeling well, so I drove to the pharmacy at our grocery store to get her some medicine. As I was walking down one of the aisles, I noticed that he was in the aisle not as a shopper looking to buy something like I was, but he was actually there at about 3 or 4 o'clock in the morning stocking shelves. I didn't go up to him and say anything because I didn't really want to embarrass him, plus I was trying to get back to my wife in a timely manner. But I doubt he was there because he was just bored and looking for something to do. And it's things like that is why I'm here sending you this message today. There was nothing I could do for him at that point. It was too late. But it is not too late for you. Now, I'm not saying that things will get as bad as they did during the last financial crisis, but they could. You have to ask yourself, is it really worth risking a lifetime's worth of work and savings to just ignore the problem and hope that it goes away? It is our passion to help as many people as we can have a secure and successful retirement. As a result, we are now offering a complimentary portfolio review to anyone who would like one. If you're concerned, please give us a call and meet with one of our advisors. It isn't too late to make adjustments. We can meet with you in person or over the phone, whatever you are most comfortable with. In closing, remember it is perfectly normal for the markets to go backwards a bit from time to time. To our clients, I am confident that through our retirement planning process, we've done everything possible for you to achieve your goals. I appreciate the trust you have placed in me and my team. Remember, we are all in this together.